the ability to raise a first-time fund now is, it feels like 2009. It's so tough. If somebody's raising a fund, particularly to a potential LP that is deep in the venture area, you have to know that, that LP's, you're at a minimum, you're one of 5, maybe even 10 people who are going to pitch that week. If you're sitting where I am in the Midwest, if somebody is raising a $75 million early stage tech fund, they all blur in my head because there's so many that sound the same. And I'm sure it's the same, it's similar in other, parts. So how do you stand out from others? To simply sort of use the words, and you hear this all the time, we have proprietary deal flow, we're operators, et cetera, et cetera. That's like everybody says the same thing. So how do you stand out? Okay, well, you stand out by not saying we have proprietary deal flow, but being much more specific. Here is why our deal flow is different than everybody else's. Here's where we draw from, and here's evidence of our ability to find companies before others do. Or it could be, as I talked about earlier, we get called into deals because we have this expertise. So here's where we stand out there. Here's where we stand out in management of our portfolio, because we have these great relationships in this industry that we're focusing on, and we can bring resources to bear that other people can't.
Hey everyone, this is Prashant and I'll be host for the VC10X podcast, and today we have Chris Rizik with us. Chris is the managing partner of Renaissance Venture Capital, a first of its kind for the funds formed by a consortium of Fortune 1000 and major private corporations. Renaissance works to attract capital to Midwest-based startups and to strategically connect venture capital funds and startup companies with major corporations looking for innovation. In this episode, Chris shares insights from his 2 decades of experience investing into VC funds, what they look for in VC funds, how it's much harder to raise a VC fund in the current environment, what's the biggest determinant of success in a VC fund, the importance of standing out for GPs trying to raise a fund in this difficult market, and so much more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called LP10X, where I help VCs start and run their own podcast. While I was running VC10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? It's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Chris, so good to have you on the VC10X podcast. How are you doing?
Great to be here, Prashant.
Yeah, it's a pleasure having you on. To start things off, can we first have your story and how you started investing into VC funds?
Sure. So I had a background. I was a CPA, went back, became a lawyer, and was a partner in a law firm, and got recruited into venture right around 25 years ago, when it was still relatively new here in the Midwest. Got recruited as a partner of a firm called Avalon, which back then $100 million fund was a big deal. And I came into that and then, worked in that area as a GP for about 8 years. And then started my own fund of funds, Renaissance, back in 2008.
Yeah, that's a very interesting story. And tell us more about Ranise and what's the focus here.
Yeah, so having been in the middle of the country, which has always been underserved for venture capital, but has a rich technology heritage, the idea behind Renaissance was to create a new type of fund. And so we're a fund of funds and three main goals. First is, of course, we're investing in trying to get in the best funds, best venture funds around the country. So we're investing for returns. Um, we invest in funds under the condition that they look at opportunities here in Michigan. We can talk about it more, but we actually help them find opportunities that they wouldn't otherwise find here, because our belief is that there are some real opportunities for them to be successful investing in this region among the other areas they invest. And then the third part, which was pretty unique to us as a fund of funds, is our initial investors were all Fortune 1000 or major private corporations in Michigan who not only agreed to invest, but to look to become customers of portfolio companies of the funds in which we invest wherever they're located. So it's this idea of being financial, an impact-driven fund, and also strategic. If we're investing in a venture fund, the fact that we're investing is a good thing, and we're showing them deal flow they wouldn't otherwise see in the Midwest, and then we're bringing them customers for their portfolio of big companies. There was simply nobody else doing that back in 2008 when we started Renaissance, and now we're 15 years later. We've raised 5 funds. We've had a good run on all 3 of those pillars that I talked about, and we've been contacted by probably every state in the union of groups trying to replicate the model that we created here in their own state. And we've helped groups replicate it in Ohio, in Texas, in Wisconsin, and to a certain extent in Southern California.
Certainly, that's very interesting story there. And what do you think has been the impact of such a regional focused fund of funds in a way in bringing up that ecosystem in that region? Since you have seen it firsthand, tell us about how it has helped the ecosystem mature in Michigan.
Yes, I mean, going back to our thesis was that if VCs can find deal flow in underserved geographies or with underserved founders, there's actually more money to be made for them. But the flip side is we've seen the impact here. So we've, from 2016 to 2020, that 5-year period, Michigan was the fastest growing state for venture capital in the union. And we played a role in that, and a lot of other people here did too. It really is trying to fix what is a friction in the marketplace. A lot of good technology and startups weren't being formed here. And our ability to bring capital to the table, or to at least remove that friction so great VC funds are meeting great technologies and startups, just to open that up would create opportunity. So, we've been able to play a role through our network in helping to attract about $3 billion of capital to Michigan startups during our period. We do that through a number of ways, including an event we call Undemo Day. And it is recognizing that, a venture capitalist in Boston or in Silicon Valley is not going to be walking the halls of the universities here. So we do. And we work with the universities, with angel funds, with accelerators, and we will identify our hot list of, let's say, the 100 most promising startups. And we literally rent a football stadium, Ford Field, where the Lions play. And these startups all get tables. And then we work for a couple months with VCs that are going to come and visit at our invitation and get them pretty rich information on these startups. And almost like a fantasy football draft, the VCs make their draft choices. I want to meet with these 7 companies if I can. And we get that from all the VCs. And then ultimately we set up sort of a speed dating date where at these tables, there are 15-minute meetings, but all meetings that have been requested by the VCs, where they'll get a chance to meet this company that they've been reading about, and then we'll see what happens from there. It's been super effective, but it has created, in a given day in October, we will help create 500-600 one-on-one meetings that wouldn't have happened otherwise. And again, it's just sort of letting the market work. Nobody's forced to do anything, but getting these meetings, great companies, great VCs that didn't otherwise have connections, leads to results, and it's had a pretty significant impact on Michigan.
Right, totally. That's a very interesting model. And I've talked to a bunch of fund of funds, and this is an interesting approach that you're also sourcing deal flow for your portfolio VC funds in a way, which is interesting to learn. So most fund of funds kind of depend on their portfolio funds to find their own deal flow and make the investments. So it's good to learn that you're also helping them on that front, right? Awesome. And when you're looking at funds to back as a limited partner, right?
Mm-hmm.
And you've been doing it for quite some time, over 2 decades, honestly. What do you really look for in these funds? What are the key things or metrics, if at all, that you track in these funds to make that decision whether you will make a commitment or not?
Yeah, I mean, the bar is really high, and I think for most fund of funds it is. So in a given year, we probably talk to, I would say 250 to 300 funds, and we'll typically commit in 1 or 2 new relationships a year. So that's a pretty high bar. And what do we look for? Well, each fund of funds has their own philosophy, and our philosophy is kind of colored by the fact we were GPs before, and we've been through cycles, and those two make us. We invest in funds that we believe will have great returns in whatever part of the cycle we're in. So, almost anybody could have had great returns in 2020. Much tougher to have great returns in 2023. And so that colors how we look at funds. So we only invest in funds that have a philosophy of investing in multiple rounds of their best companies, because you never know when that market's going to turn. And, we've seen so many funds that, we'll see a $50 million fund that does 50 deals, and they're only doing seed deals. And that's great when things are going up and to the right. But when things turn like they are now, and you have to be able to play defense as well as offense, that's a real challenge for those funds. So we've never invested in pure seed funds. We'll invest in funds that come in at the seed level, but they have to have a strategy of doubling down on their winners over multiple rounds, particularly because if the market turns, they need to protect their positions in their best companies. So with that in mind, if you look at, what we're looking at is what is each element of what it takes to become a successful fund. There's that overall philosophy that I talked about, but there is, deal flow. Do they have an extraordinary way of finding great deal flow and getting into great deals? Then once they do that, next, how are they at managing the portfolio? How are they as board members? How are they at driving value? Again, if you see a fund that has 50 deals in it, it's tough to see how a 3-partner fund with 50 deals can really add value on an ongoing basis. They're more indexing, it seems to me that. So, we believe we want to get in funds that have the ability themselves to drive value, typically through industry knowledge of how to work with fast growth companies, and help with attraction of talent, help with attraction of capital, all those things. And then the third element is exiting. And this is where I would say a high percentage of VCs kind of fall off. A lot of great VC funds that have good deal flow and that know how to drive value to the company, but maybe less mature is their strategy for exiting. And in the end, right, the exit is what makes everything. TVPI doesn't mean anything until you get to DPI. And we've been pretty heavily focused on this for a while. Obviously, 2024 is a time when everybody's focused on DPI because the hold periods for venture funds keeps getting longer and longer and longer. And I know we'll get into this later. That feeds into the trouble fundraising this year for VC funds because everybody's so engorged with VC holdings on the LP side. So really focusing on VCs that have a philosophy about how they're going to exit, when they're going to exit, what their metrics they're looking at to exit. So it's not simply we're going to invest and see what happens. It is we're going to invest knowing that at this point we're going to look to exit all or some piece of this. And here's how we're going to exit. How are we going to create, we can't just rely on the CEO for exits. How are we going to help that? Are we going to be entering into discussions with potential buyers? Are we going to be talking with investment bankers and really becoming a driver of exits, which is something that I would say, quite honestly, very few VCs are exceptional at. But that's been a particular focus of ours. And I'll pause there because I've gone on quite a bit.
No, that's good. There are multiple things to unpack there. So you mentioned about you want to back GPs who are kind of immune to different cycles and can produce returns even in down cycles, right? So you mentioned one way to do that is by investing in subsequent rounds of companies. So for a GP to invest in multiple rounds, there has to be some follow-on capital or reserve capital in the fund, right? So what is a good percentage of reserve that you advise that GPs should set aside, and what do you see in the market?
Yeah, I mean, it's different depending when they first come in and the amount for which they first come in. So, for instance, we have a number of biotech funds, and in the biotech world, it has moved over the past 10 years to really largely focus on company formation. So, it could be this biotech fund is creating 10 startups themselves and starting with a few $100,000. Well, for them, their reserves are going to be, 20 times that amount, and that's different than if you're a Series A tech investor, you're coming into Series A at a pretty good check, you might have 1-to-1 or 1.5-to-1 reserves. So it depends on the sector, it depends on the stage that you come in. Ideally, I believe you should be able to stay through 3 rounds. And that's just a rough number. But that seems to be, you get to this point, and again, having been a GP, I lived this and probably learned it the hard way. You invested in a company, it's going great, everything's going great, and the next round comes. The decision is, you've got $5 million sitting on the side. Do you put that $5 million in this company that you've worked really hard on, that's moving nicely, you're already committed and on the board, so you're spending your time, or do you put it in a new deal? I would say too often the decision is we're going to do a new deal, as opposed to, I'm already spending a ton of time driving value here. I still think there's value to happen. I'm going to double down on my winner, which goes to another philosophical element that we have. We are big fans of what we call high conviction investors. So, a portfolio of 50 companies isn't that high conviction. A portfolio of 15 companies where you're getting meaningful percentages, and that's really the key. Is it's not the number of deals, it's the percentage ownership that can really drive your fund. There's nothing more frustrating than having, a 7x or 10x deal in your fund, and you've just returned 15% of your fund. I mean, what a waste, because you didn't have the conviction to get high percentages in a deal that was going great that you believed in.
Totally. That's interesting to learn. So do you also prefer GPs who have the capability and the money power to lead rounds, because that gives them the ability to have a better ownership percentage?
Yes, I mean, that's great. They don't have to, but as long as they can get that percentage ownership, that's the important part. In most cases, they would be leads. I could see, there are some GPs that have such an expertise that they get called into interesting, either, it could be something like a deep tech round or something. They get called into these other deals because they're bringing a certain expertise, but they're able to get the kind of ownership they want, even though they're not technically the lead. They're bringing a special talent that makes others want to bring them in and allows them to get meaningful ownership.
Absolutely, that's good to learn. And so you mentioned you're only making about one or two VC commitments per year, right? So that's a low number, right? So you want to have a concentrated portfolio, right? In that, and once you have backed these VC funds, how long does that relationship typically go? And how many funds are you backing for multiple funds? That okay, if you backed you for this fund, next one again, the next one. So give us an insight into that.
Yeah. So when I talked about the one or two, that's one or two new relationships. In addition, we'll be doing re-ups during the course of the year. So I think the funds in which, in 15 years, the funds which we've invested the most in would be 4 or 5 times we've done re-ups in those funds. And so, that's not atypical. They come back every 3 years typically, sometimes a little bit sooner, sometimes a little bit longer. And if we look at it's like, okay, this has been a great relationship. They've engaged with us. They listen to us. But of course, most importantly, they've got strong returns. Then that known quantity certainly has an advantage over what would be a lesser known new relationship. If you looked at percentages, probably I would say it's varied fund to fund, but probably somewhere between 60 and 70% of funds we invest in, we end up re-upping in. We tend to invest in funds that are probably considered emerging funds to more institutional investors. So, a typical place for us to come in is maybe a fund 2, fund 3, or fund 4. And so we come into these funds and, we sort of see how it goes. And, that can drive relationships. We also will come into, there's sort of this interesting twist of what I would call, jokingly, emerging fund 10s. And these tend to be funds, often name brand funds. They had kind of the first wave of success, and maybe those initial founders have retired. Maybe the fund even went into some hard times, and then a younger crew came in and, at fund 7 or fund 8 and started bringing back that name, so that it may look weird to say we're investing in a fund 10 that's emerging, but with this management team, it's an emerging fund. And so that's another place where we've come in. It's tough for us to, I can't think of a time we've come into a new relationship of $1 billion fund. That's just not where we play. Our sweet spot would be, let's say, 70 million to 500 million in fund size when we first would get into a fund. And I would say it tends to be managers that are still pretty hungry. And we think it's easier to make money. You can do all these follow-ons that we talked about, in funds that size, because, at $1 billion, it's tough to deploy that type of capital and kind of get the multiples that we want to get.
Right. Totally agree. And that's an interesting thing you shared about Fund 10 being an emerging fund, right? So what makes them an emerging fund at Fund 10? So what I see in most funds, when they reach to maybe a Fund 10 stage, their AUM goes up the limits, right? So is that not the case for those funds, that they're still within your investing range, your LP deployments range? And yeah.
And what's typically happened is, in many of these cases, the first team, that made this a name brand, took it up through fund 4 or 5, probably had a bad fund, and suddenly their fund 6 was half the size of fund 5. And so, after climbing, they kind of went back down, and then the younger team had to restart it with smaller funds to build that name back up. So by the time they get to us, yeah, they're a $200, $300 million fund, even though maybe their fund four was a $600 million fund.
Right, that's very interesting to learn. And you mentioned about how DPI is back in focus, right? So when you're making these investments into VC funds at maybe a fund two or fund three stage, there's still not a lot of data on the fund one or the previous funds to know if there's enough DPI in that, right? So how do you evaluate that fund, right? So one is that question, and the other question I want to ask is, within your portfolio, are you trying to push for some DPI within portfolio, that okay, maybe look at some secondary transactions, get some DPI? So give us a perspective into that as well.
Yeah, both great questions. So if we look at a fund two, it will typically have managers who maybe had experience at other funds before this. You know, we like experienced managers, whether they're in a fund two or fund three. So you're right. It's tough to just look at the fund one when we're looking at fund two, unless somehow they can, convince us here is how we have this strong exit strategy. Here's the relationships we're building with bankers. Here's the relationships we're building with PE funds that are going to buy us. And even though they don't have the numbers yet of DPI in fund one, we're convinced that they have the relationships and the strategy to do that. Once you get to fund three, there usually is some indication, at least from fund one, that they know that they're good at that. But you're right; that is a real challenge sometimes, and sometimes we kind of have to take. We have to look at the strategy and say, okay, we believe enough in the strategy, even though it hasn't necessarily borne fruit yet. But we believe enough in the strategy, we think it will, and so we're willing to take that. Your second question is dead on point, and that is creating DPI, I would say, on an interim basis. We are big fans of funds that, as part of their strategy, say, okay, if we're going to take company public, when and how much are we going to sell at different price points? And some of the really good funds, they go into this going public, and they're like, okay, this stock is at 10. At 12, we're going to get our initial capital back. At 15, we're going to sell some more. And this is kind of the strategy to get DPI. There's nothing worse. Company goes public and the fund just rides it, and all of a sudden it goes down to 1. So getting money off the table is big. This is even truer in funds that are selling companies to PE funds. And as PE fund comes in, man, we love it when funds say, you know what, this is a really big one. Let's take 2X off the table right now as part of the recap with the PE fund. And then we'll ride with the PE fund for the rest. I mean, they've reduced the risk so dramatically. I get it. There's a chance that thing's going to continue to shoot up like a rocket. As an investor, though, if I'm focused on DPI, but I'm really focused on IRR. I mean, you're helping me with my IRR. If you think, because then I'm distributing it to my investors. If you think about how institutional LPs measure success, what do they do in the public markets? IRR. What do they do in all the other asset classes? IRR. Why shouldn't they be doing IRR for VCs? And the way you get IRRs often is to know when to take something off the table. VCs are compensated based on multiples, on TVPI and really on DPI. That's different than IRR, though. So there is a bit of a divergence in how institutions measure success with how carried interest is paid. That's an unfortunate divergence, but I think some of the great funds recognize that and are trying to do both.
Right. Yeah, great answers to both questions. And let's talk about portfolio construction at Renaissance, right? So how do you approach portfolio construction and even the risk management aspect within your portfolio?
Yeah. So, in the end, for many of our investors, we are their play in venture. Um, they might care about the impact work we do, but ultimately, they're investing in us largely for access to venture and access to great venture funds that they don't have. So we're trying to create a pretty broad portfolio. I mean, I'm kidding myself if I think I can predict over the next 10 years what sectors are going to be hot when. So we're trying to hit, we're about a third healthcare, and that's biotech, pharma, medical devices, healthcare, IT. We're 40 to 50% general tech, and that's everything from regular enterprise tech, it's cybersecurity, it's all the other types of general tech you can have. And then we're always looking at emerging areas, advanced manufacturing, advanced materials, ag tech, things like that. And we're trying to be able to get access to areas that we think could be hot in the next 10 years, but to be weighted in such a way that, there have been times when biotech absolutely carried our fund. And then when that suffered, we were using, cyber to carry the fund. And I don't know what's going to be hot when, but if we have this balanced portfolio, hopefully, I mean, it's great if everything's going up at the same time like it was for a couple of years there, but that's the anomaly. What usually happens is something's hot and something isn't, and you hope that what's hot balances out so that you end up with a return profile for your investors that is consistently good.
Right. Totally. And at the start of the conversation, you mentioned about how Renaissance has corporations as LPs, right, in the fund of funds, right? So tell me about how you thought of that strategy that, okay, I'm going to bring corporations as LPs because that's not the typical LP type that people think of when they're raising a fund, right? That's one. And the second is, how does that help you add more value to your portfolio funds? So, yeah.
Yeah, so part of the formation of Renaissance goes back to when we started in 2008. Michigan had been in sort of a one-state recession for a while, rough period mostly because of the automotive industry. And so Renaissance was formed in cooperation with these anchor corporations in the region who, quite honestly, in the first fund, they really wanted something that would jumpstart the region, and the recognition that venture capital played an important role. So I think in the first fund, I don't know that they believed they were going to make really good money on it. I don't believe that they truly thought this was going to be a strategic value to them. They did it because they wanted to help Michigan, and they were so willing to do it. That became a way for me to raise this very unusual fund at that time. There wouldn't have been many institutional investors back then who would have come in to this kind of new idea of a fund of funds. These corporations cared enough about Michigan that they did it. So they were the perfect investors in Fund One. And that allowed us to create a track record. And we were fortunate, raising a fund in 2008 and 2009, tough time to raise a fund, pretty awesome time to invest a fund. And so we started seeing success pretty quickly, so that when we raised our second fund in 2012, institutional investors could look back and they could see pretty strong markups, pretty strong distributions. And, so it was the corporations that enabled us to create the track record that allowed us to get institutional investors. So that's how the corporations fit in. But because of this model we created where, I talked earlier about access to great funds is so important. And one of the ways we got access to great funds was through these corporations. This idea that, okay, talking to a venture fund, sure, we'll invest in you, but we have relationships with 20 major corporations that could become customers of your portfolio companies. I mean, there's no fund of funds in the world that's bringing customers. So the corporations played a pretty important part of our being able to get into the best funds. And I want to give credit. There's an organization called Business Leaders for Michigan, which is a collection of CEOs of corporations in Michigan. without their help and without their partnership, it would have been tough for us to even get this going, much less create this new model of venture capital. So the corporations have continued to play an important role. And if we're talking to a fund, on the coasts or wherever, and they're oversubscribed, there is zero chance this little fund of funds in Michigan should be able to get an allocation in that. But we come with such a different value proposition that there are very few funds that won't let us in and won't carve back somebody else to let us in because we bring so much that other investors don't bring to them.
Totally agree on that. And you've seen a lot of game film over the past 20, 25 years investing into VC funds. What do you think has been the biggest determinant of success of a VC fund that can be spotted early on in the journey when there is not too much data to look at?
Yeah, I mean, it goes back to, part of it goes back to what I talked about earlier. We believe in high conviction funds and funds that know what they stand for. So where we've seen success is funds that aren't just doing club deals. There's a certain FOMO in venture funds, where, okay, now all of a sudden AI is hot. And so we're going to do AI deals. And if you are not a firm that has a firm understanding of AI, number one, you're not going to get into the great deals. And number two, you don't add much value to those deals. And so I respect quite a bit of fund, and there are a number of funds that have come to us and said, look, we understand the importance of AI. We're not doing AI picks and shovels deals just because everybody else is doing it. That's not where we're great. But certainly AI will play a role in the companies that we look at, and and that will be important to us. But here's what we stand for. We're going to look in these industries. We're going to look at these technologies that we're really good at. And then going back to what I said earlier, here's how we get deal flow. Here's how we manage. Here's how we exit. And we are going to make sure that in our great companies, our LPs are going to be really rewarded for the great companies we have because we're going to own enough of them to do that. And that's worked for all 15 years. The funds that are just looking, when they're trying to keep up with the hot areas, they're always a step behind. So the funds that are getting into AI now, they're followers, and it's going to be more difficult. There are certain funds, and we're in a few of them, that they embraced AI before it was the buzzword, and they were using it as a means of improving their fund. The other thing that we see success in, there are funds that sit at their desks like I am and wait for emails to come in or phones to ring for deal flow. Then there are funds that are proactively identifying white spaces. They have research teams that are finding who's the best at this, and then they're doing outreach maybe even 2 years before they're going to do a deal. So they're talking to the people who are going to make changes in this industry, and they will be ready when that company or that technologist, hits the point where they will be investing. That's consistently worked.
Right. Totally. And in the current environment, how do you advise a GP on how they should be deploying into startups? What should be the speed of deployments, ownership targets, or maybe they should be having a wait and see approach that, okay, let's see if the valuations go further down and maybe we can get a better deal. So what would be your suggested advice for GPs?
There was sort of this false choice back in 21, especially, that you had to choose between good companies and reasonable valuations. I disagreed with that. I also disagreed with the funds that just kept up the pace and just paid whatever the market said for valuations. I also disagreed with the funds that said, you know what, we're just going to wait it out. that tells me that in the first case, again, they're just for them it's just about deployment and not really thinking through ultimately, what they're investing in companies that they're going to make money because companies' revenues grow, but they also have to get companies where the multiples grow. And there was a whole generation of funds in 2021 that were coming in and saying, you know what, we're going to wave the white flag on growth of multiples. In fact, we're going to have compression of multiples when we ultimately sell. So we're putting so much pressure on revenue growth. So that really wasn't a strategy for winning. The funds that are taking a wait and see approach, problem is, while they're waiting and seeing, they're charging fees. It's going to be it is actually really tough to catch up. If you've gone 2 years of charging 2.5% a year and you haven't done any deals, man, that's a real drag on your fund. So I would say funds that, and it applies right now, funds that have discipline on valuation, they're coming in at a 7x. Maybe it's going to go down to a 6x. That's not a reason to wait. If you find the deal you want and it all makes sense for you, you believe in management, there's reasonable enough valuations right now. So it's maintaining discipline and just getting into high quality companies, and high quality companies are available right now at reasonable valuations. This idea of just kind of waiting, it's too harsh to call it lazy, but I think it's misguided.
Yeah, totally. Good perspective on that. And you must be getting approached by a lot of GPs, like you said, every year around 250, 300 GPs pitching you to get commitments, right? So you have seen a lot of VCs pitching you. You have seen a lot of GPs making mistakes while they're pitching you, or taking the wrong approach, or making blunders, right? For a new GP who's trying to raise a fund, what would be your advice on how they should be approaching LPs? What should be the correct way? Should they be taking warm intros, or how should they be writing cold emails? And what all information they should be having handy to be able to convince the LPs when they get a meeting? So any insight on that would be helpful.
Yeah. And I feel bad right now for newer GPs. It's a tough time. A first-time fund, the ability to raise a first-time fund now it feels like 2009. It's so tough. So I feel bad for there's a lot of really smart people trying to raise their first funds, and that's tough. But putting that aside, if somebody's raising a fund, particularly to a potential LP that is deep in the venture area, you have to know that that LP's, you're at a minimum, you're one of 5, maybe even 10 people who are going to pitch that week. If you're sitting where I am in the Midwest, if somebody is raising a $75 million early stage tech fund, they all blur in my head because there's so many that sound the same. And I'm sure it's the same, it's similar in other, parts. So how do you stand out from others? To simply sort of use the words, and you hear this all the time, we have proprietary deal flow, we're operators, et cetera, et cetera. That's like everybody says the same thing. So how do you stand out? Okay, well, you stand out by not saying we have proprietary deal flow, but being much more specific. Here is why our deal flow is different than everybody else's. Here's where we draw from, and here's evidence of our ability to find companies before others do. Or it could be, as I talked about earlier, we get called into deals because we have this expertise. So here's where we stand out there. Here's where we stand out in management of our portfolio, because we have these great relationships in this industry that we're focusing on, and we can bring resources to bear that other people can't. And same thing through exits. Here's what we've done. So it's particularly difficult if you're a generalist right now. Gosh, it's hard to show anything unique about yourself if you're a generalist. So I think it really is showing why you are something special in what you do, um, because there's just so much competition that it's really tough to remember. And I'm saying this honestly, I feel terrible saying it's just tough to remember the third interview I had 2 weeks ago with somebody.
Right. Understandably, right? And my last main question before we do the rapid fire round, how
Yeah.
do you like maintaining the LP GP relationship within your portfolio? How often do you like to receive updates from them, and what all information should be included in those updates?
So every GP sends a quarterly report, which is, here's the deals we've done, here's our view of the market, here's performance and all that. And that's sort of table stakes. Um, some of the great GPs schedule a separate call once a quarter. And, it's just sort of like catching up. Here's what's going on. Um, I would like to think that we have, if you're a GP, a universe of one fund. If they call me, I'm seeing a marketplace they're not seeing. And so I think the great GPs are calling people like me, but lots of other LPs and saying, okay, what are you seeing in the market? Here's some things we're thinking about. How does that fit with what you're seeing? And, trying to get information from us. Like the GPs I'm in, they understand the technology way better than I do. They understand so many things way better than I do. But I'm coming, if they're coming to me, I'm able to give a 30,000 foot perspective that it's difficult for them to see. So I think I really appreciate funds that are reaching out and we're having good conversations back and forth, because I think we can help make them better. And, in the end, we are relying on them. We're relying on them and their expertise. So we obviously have a high regard for them. But we see some stuff they don't see. So it's good when we have regular conversations about strategy and about what's going on in the marketplace.
Right, totally. LPs certainly have a broader view of the market than GP, so it's always good to stay in touch and get those insights, right? Now, let's do the rapid fire round. I'll ask you 5 quick questions about the investing you're doing,
Okay.
and you have to give 5 quick answers, right?
Okay.
So, the first one is, what are the sectors and regions you invest in?
We will invest in funds anywhere in the country. We've done all U.S. funds. Sectors are as broad as can be. We do everything from tech to healthcare to the emerging spaces I talked about earlier.
Got it. What's the typical fund stage you're interested in?
We will invest typically in funds that are coming in at the Series A round. We do some that come in a little bit later, some that come in earlier, but in all cases, they have to be funds that are looking to invest in multiple rounds and to sort of continue to invest in their winners until it doesn't make financial sense to do so anymore.
Great, great. And you're mostly interested in fund two and beyond, right?
Yes. We'll do fund
Got it.
ones of experienced managers. We won't do
Mhm.
fund ones of new managers.
Got it. Got it. What's the typical check size you put in?
Typical is 3 to 5 million is typically what we will put in the fund.
Got it. Where can GPs get in touch in case there's a direct way?
So probably the easiest way is, on social media, I'm at Chris Rizik, Rizik, or go to our Renaissance Venture Capital website, and there's a contact us mechanism there. Those are probably the easiest ways to do it.
Awesome. Last one. Where can our listeners follow you?
So there you go on social media at Chris Rizik. If they are music fans too, which is an unusual thing, I have my own startup. I started it up in my kitchen 20 years ago. It's a music site called Soul Tracks. If anybody's a soul music fan, we're actually the #1 soul music site in the world right now. And that's on nights and weekends. I'm writing about music when I'm not doing venture capital. But yeah, at Chris Rizik is the best place to follow me on most of the social media sites.
Awesome. And that music aspect is great to learn as well. Thanks so much for making time for this, Chris. It's been amazing talking to you, and I wish you happy investing.
Thank you, Prashant. Great questions, and thanks for what you're doing for the community with your podcast.
Thank you. I really appreciate it. My pleasure. Thank you.